Yeah, it'll be worse than 2008. And I don't mean to say that to be doom and gloomy. I mean to say that people don't understand is, when the pandemic hit, the US government borrowed a monster amount of money, trillions and trillions of dollars, and gave it to people. And then we started to spend that, and that really created this massive amount of prosperity. So if you start looking back at history of monetary policy and bubbles, you see kind of this repeating kind of thing. Somehow a lot of money is created, whether it's directly printed as we've seen in the past, or whether it's borrowed, or there's credit expansion. You see these big bubbles, but they have to pop and come not back just to where they were before the bubble started. They go below that. And that's the challenge we're facing, is everybody's got this belief that, hey, the economy's reached a new normal. The problem is that new normal, that money is gone or almost gone. So what happens? If the banks aren't lending, if people aren't spending, then we have to have a mean reversion, and we usually overshoot that reversion to the downside. In that case, to me, the base case is it is going to be worse than global financial crisis.
On this episode of What the Finance Podcast, I have the pleasure of welcoming back Steve Van Metre, who's a money manager and YouTube. And I think it's been close to a year since we last spoke. So, Steve, thanks so much for joining the podcast.
Anthony, it's a real pleasure to come back on your show.
No problem. Yeah, a lot's definitely happened since then last year. I think it's felt like a little bit longer for most. So, I guess in your opinion, can you maybe give us an overview of what you're currently seeing in markets, in the economy, in banks? There's been a lot happening. So, what are you currently watching?
Yeah, I mean, in case of the markets, we're clearly seeing investors are buying into 100% into the Fed soft landing view that we're on the cusp of the beginning of the next bull market. People are just buying stocks. They're buying every dip. They just can't get enough of it. They totally are convinced the interest rates are not only up, but are going to go a lot higher, which is really interesting. We just not kind of a narrative we've heard from investors in a long time, but now they're completely bought into the perspective that, the 10-year Treasury yields could, easily be 6, 7, 8%. And they believe that that's going to happen. As far as you look at the broad economy, I mean, just globally, clearly we're seeing a slowdown. I look at Germany, to me, what looks like a factory depression going on there. And I just read an article today about Germany. And Anthony, this is funny. They're like, hey, you know what? We don't think that Germany's going to pull the rest of the Eurozone down with it. It's like, okay, I don't agree with that. But, you look at China, you see the property sector is in trouble. And the property sector, they're so highly connected to the banks, and they're slowing down. You come back to the US, again, in this fantasy notion here that we're going to see a soft landing, but it's almost as if nobody's really looking at what's going on in the bank still. You know what I'm talking about, Anthony? I mean, the banks are hemorrhaging. They're in big trouble. They're insolvent, and nobody's even cares anymore. And I'm thinking, man, the next thing that goes wrong here, we're not going to see just a bank failure. We're going to see dozens of bank failures because they're just in that bad of shape. So I look around the world and I say, the notion that this is all going to just come to a nice pillowy soft landing and then we're going to rebound. Minimal case global recession. Likely case there's going to be several financial crises. I think China's banking system, U.S. banking system, and who knows what else where that will show up.
Yeah, wow, it's a lot. It's scary to think. So, if we maybe focus on the US at the moment, so you said the banks are really in trouble and they're insolvent. So, can you please maybe explain a little bit more about that and why you're worried for a lot of them?
Yeah, because following kind of the March crisis, what we expect to see is banks go out there and tap short-term funding programs from the Fed, which they did. Then the Fed came out with a bank term lending funding program, BTFP, I believe it is, whatever the acronym of the day. That's more of a long-term program where banks could go there, swap their Treasury and mortgage-backed securities for cash. The dangerous part is they're paying prevailing rates and the term is longer, so they do have to be paid back. And many people said that's a bailout. No, it's a loan. Now that will eventually the loan turn into a bailout? Well, that's a whole different story to come. We know they went to the Federal Home Loan Bank and borrowed a massive amount of money. And what you want to see, it's one thing when you have a crisis and something goes wrong and someone borrows a lot of money, but the real key, Anthony, is, if I have an emergency and I'm borrowing money from you, what we want to see is me paying you back relatively quickly. And that would give us the indication that he had a crisis, he overcommitted, he just took out too much money, now he's paying it back, and he's doing it on a regular basis. What we're not seeing is a lot of this getting paid back. In fact, with the bank term of funding program, banks are taking more every week, and that's not a good sign because it means the banks are still unhealthy. And what they need is they need deposits. They desperately need to get deposits back in. What we're seeing is a contraction in commercial banking deposits, something we very almost never see. I mean, this is unusual. So money's flowing out of the banks, but you start to step back and look and say, why is it leaving the banking system? Well, as silly as it sounds, and it does, the Fed's competing with the commercial banks. And it makes no sense, because if the Fed really understood what they were doing, and they don't, they would actually be encouraging money to flow back into the commercial banking system by getting rid of the exact program that is causing part of the problem, which is their overnight reverse repurchase agreement program. And so what that is, Anthony, if you're not familiar, your listeners aren't familiar with it, is when you go to when you have a money market account, some of that money is actually being parked at the Fed overnight and being backed and paid by, the interest is being paid by the Fed. You may not exactly see it, and that's kind of the intent of it. It's meant to be something in the background, but the Fed is effectively paying current market rates on that at a time when you go and look at the bank portfolio. So you look at, how they pay interest. Well, they do it through originating loans, and they do it through buying Treasury and mortgage-backed securities and T-bills. Well, you look at where the banks bought a lot of their securities and originated a lot of their loans, it was at the bottom of the pandemic. So, at the time when rates were just dirt cheap, they loaded up on this stuff, and they can't compete with the Fed. So if you've got a deposit at one of these small and mid-sized commercial banks, and you're saying, well, why aren't they paying me enough? Well, they don't have the money. So you go and pull your money out and go to the Fed, and then all of a sudden the banks have to turn and borrow more money to the Fed to fund your deposit flow going out, and it puts them in a dangerous position because they just don't have the capital. And then we're seeing signs that they're going to be forced to issue more stock, which is not going to go well. And then at some point, we start to see a big flood of commercial real estate start to come due. A lot of these loans that are held by these small and mid-sized banks, they're going to have to write the loans down, but they have zero margin. They have nothing. So at some point, the crisis that we saw in the banking system here back in March, it's coming back. It's going to be far worse than before. And what's weird to me, Anthony, is no one sees it. The regulators are acting like, oh yeah, we wallpapered over this stuff. It's all good. No, it's not, because if it was good, the banks would be paying back all these loans instead of taking more.
Yeah, makes sense. There's so many things he said that's sort of working at the same time that are moving in motion. And I recently spoke to Randy Wood, and he was talking about how a lot of these the Fed actually tell them, please, yeah, as you said, sell equity, use our facilities if you have to, get as much cash as you can, because they're concerned of the issues they're moving forward with a lot of the things that you mentioned. Do you see that potentially the Fed could just continue the loans that they've provided in perpetuity? There's actually not going to be, because at the moment I think they're lasting for a year, but could they just get to the point where like, no, you don't have to pay them back, or it's going to be multiple years, or is that where the bailout comes into play?
So that's a good question, because a lot of people think that this turns into a bailout, but the Fed has no legal authority to wipe these loans off the book. It's zero, none, periods. They cannot do that. Now, can they extend the terms of it? Sure, but it doesn't help the banks. I mean, it doesn't help it at all. In fact, you look around the world, and what you hear now, particularly coming out of China, is restructured loan. Give them a little more time, another 6 months, another year, and everything will be fine. So the idea here that, well, maybe the Fed will come back later and say, hey, you know what? We said it was a year, but we'll push it out a little bit. It doesn't change the problem, because the banks are paying market rate interest on these loans. So they have to effectively generate more than that. That's the problem. They're not doing it. They don't have the loan book. In fact, if we look at commercial industrial lending on a weekly basis, as of last week, we saw a 1.1% growth rate on a year-over-year basis. So if we were seeing that the banks were going to come out of this, what we would ideally want to see is them originating more and more loans at these higher rates, and to say that, hey, maybe we're a little behind the 8 ball right now. That's okay. But look, we've got a lot in the pipeline here. We're originating a ton of loans. We expect that to continue to go up. And then once we get some padding built in, then we're going to come back and start paying down these loans. We're seeing just the opposite. Commercial industrial lending is on the cusp of contracting here. And that starts to mean that you see more loans being paid off than are originated. Now, that to most people, Anthony, that okay, so what's the big deal? Well, so here's the problem. In our monetary system, new money is not created by the federal government. It's not created by the Fed. It's not created by your local credit union. It's created out of the commercial banking system. So only the commercial banks have the ability to create money out of thin air. It's part of our fractional reserve banking system. So if you think about the new money being created when a new loan is created, that would be a good thing to sustain the economy. So if it's going in reverse, well, here's what happens. Anytime a principal payment is made on a commercial loan, whether it's part of your regular monthly or quarterly, or maybe you just want to come in and say, hey, I want to put a big chunk of money and pay part of this loan off. That principal is removed from the economy. It's destroyed from the financial system. So you start to think about kind of the, let's come back to these small and mid-sized banks. What do they need? And what do they need a lot of? Deposits. How are deposits created? Well, when commercial banks lend more money. Well, so if commercial bank lending is about to go in reverse and we'll see money destroyed, well, what the problem now is the banks really have no means to get these deposits. The only solution is the Fed is going to have to end its overnight reverse repo purchase program, which it doesn't even know is a problem. So it's even worse. The Fed doesn't even acknowledge what they're doing, but they've got trillions of dollars that they need to get out of that program back into the banking system. The reality is the only way this happens is Fed goes back to zero. That's it. That's the only way.
Yeah, and if you think about it, the Treasury are also trying to sell bonds as well. So the Fed are basically taking liquidity out of the whole market.
Well, yeah, I mean, the Fed's competing with the T-bill market right now, which is fine because there's not enough T-bills out there to begin with. I mean, the Treasury, instead of issuing more notes and bonds, should be issuing far more bills and not trying to refinance. So the Fed could be you're right, could be putting liquidity back into the market. That would be a plus. So you kind of look at kind of the end game for the U.S. banking system. I say the Fed's back to zero, and that may not even be enough. I actually think the Fed's going to have to concoct some mechanism to go negative. Now, we know legally the federal funds rate can't go below zero. And now the popular belief, including what the Fed is telling us, is, oh, we could lower the funds rate, but we're going to still do quantitative tightening. No, you're not. No, not a chance it's going to happen. The Fed's going to go back to QE. And, a lot of people say, well, this can't happen. Yes, it can. And here's exactly how it does. You start to see more banks fail. Borrowing more money didn't fix the problem. Fed has no legal authority to give them money. Can't cancel loans, can't do anything. Fed is a lender of last resort. That's it. Congress, not too likely to step in here and start wiping out these loans for the banks because it doesn't look good. And they don't do that anyways. So you think about what the problem is for the banks. They're competing with the Fed for deposits. They're upside down on their Treasury and mortgage-backed securities that they bought at ultra low interest rates. They're also upside down on their loan book. So if you think about it, if they could sell stuff to get cash, they can't because they're losing money. So how do you put the banks back in a position of potential solvency? And again, I'm using the very carefully, and I'm using the word potential because I'm not saying that this would work. I'm saying it would help, because that's the problem is we're going to see money being destroyed here. That's going to be a big problem for the banking system. You go back to zero. All of a sudden, those Treasury mortgage-backed securities, now they have a positive carry. They're back in the black. How about your loan book? It's back in the black. Problem is, you've got to get this money out of the overnight reverse repo. The only way you do that, drop that rate to zero, and then potentially just close a program. Now, and the Fed normally doesn't do that, but the smart move would be, it says, hey, money market funds, we're done with this thing, so we're going to start scaling it back, and that money would then have to flow, back toward the banks, which is really where it needs to be, and maybe they've got a chance at competing if the Fed can even take rates lower than that. And that's what they're going to have to do. They're ultimately going to have to get rates down even lower, or the banks are just going to fold.
Yes, I guess that money coming out of the reverse repo potentially, because if these banks are in stress, even with interest rates going, decreasing back to zero, there's going to be lots of bonds and bills on the market. So are you thinking that the reverse repo money is going to come in and maybe pick up those bonds, or is there going to be the risk that there's just going to be too much supply out there?
Well, the reverse repo money is from money market funds. So if you look at the money market fund act or read into it, it doesn't say specifically that you can only buy T-bills, but if you read it, it pretty much says that you can only all the rules and the conditions. Pretty like, oh, I think the only thing that fits is a T-bill. So we know that these money market funds will come back in and buy T-bills. That's not the issue. You think about from the bank and who competes with money market funds for deposits is okay. If the money market fund is paying 5 and I'm paying 3, then we have a problem. But if the money market fund is effectively paying 0 and we're paying anything better than that, maybe some money flows back out of that into the banks, which they'll need. The problem is if you start to see bank failures, people aren't going to do that. Not at all. And that's the risk now is you have the question is, can the Fed or some other government agency come in and put some implicit backstop on the banks? Well, we saw them attempt to do that. And I don't know that that's going to be the answer either. So you kind of see that the Fed needs to get ahead of this before it gets bad. The problem is we'll start to see bank failures, which will cause panic, cause people to get out of the bank and go to money markets. Money market rates will then go negative, but people will stay there because there's no other choice. And that's one of the challenges. People say, why would I lose money here? Well, if you can't put your money in the bank because you think your bank's going to fail and you have to go to the FDIC to get it, and who knows how long that takes, or maybe you lose, 0.2% in a money market fund, but at least you can do the math on what's going to be there next week. People will take the negative rate on money market all day long.
Yeah, that sounds like a snowballing effect similar to what we saw in 2008, where there's just no trust, and then things dominoes fall until the Fed or someone else comes in to save the market.
Yeah, that's exactly what's likely to happen here is you start to have a financial crisis. The problem is, before it was in the housing market and mortgage-backed securities. So it was more affected. We saw more of the bigger banks, more of the investment banks start to take a hit. This time it's going to be your local bank. And that's going to be, to me, the really big challenge here. You're going to have a loss of confidence. And then people are, the issue won't be, is there enough government debt? The issue would be there won't be enough government debt. And that's what will drive rates ultimately negative because everyone's going to look for safety and they're going to say there isn't any. And at that point, if the Fed continues to, is it 0? Well, the overnight reverse repo rate will be at 0. So you take off the cost of managing the money market fund because there is a cost. That's the part investors will eat until the Fed figures out how to take rates even lower. The only answer to that is quantitative easing. And then you have the fact that then now Fed's competing for T-bills. So that potentially drives rates down. The math on this isn't good because it tells us that even though we have the perception right now that the small and mid-sized banks are in good shape, they're okay because we're not seeing it in the news. There's really no fires that are brightly burning. We can't see stuff. The problem is they're in triage. They're in bad shape. They're in the hospital, and no one's got an answer other than time. And the problem is, I don't think we have enough time.
A lot of people have been talking about how they think inflation will be higher for longer, especially the Fed, and they're saying that interest rates will be higher for longer as well. So you think inflation will still be there, or will it just get to the point where, no, you're shaking your head?
No, I love it when people keep telling me inflation is going higher because they don't understand how the monetary system, financial system actually work and what the Fed has actually done. So of course you have a banking crisis. That alone is going to do enough to keep people from spending. That's a given. But if we just kind of look at some of the headwinds coming up, we've got the student loan repayments coming back. That's going to take some money out of the discretionary side. Higher interest rates do after about 2 months feed into credit card minimum payments. That's going to be a factor here as well. Not to mention we're just seeing an overall broad slowdown in consumer spending. But in terms of where inflation is going, you have to have money to grease the wheels to get people to spend. So typically Americans swipe, borrow, or somehow access credit and spend. And that's generally the business model here. So if you look at what happens when the yield curve inverts, and there's various curves, but we'll just stick, say, with a 10-2s, which is a 10-year yield less minus the 2-year yield, which right now tells us 2-year yields are higher than 10. And the reason that matters, Anthony, is banks borrow at the short end and lend at the long end. So if short-term yields are higher than long-term yields, well, you can do the math as a business. you don't make money. So the bank's response then is they tighten lending standards. And so rather than tell you no, they just make the requirements for you to get a loan so darn difficult that if you happen to do it, maybe they can make some money on origination fees or that. But most people look at that and go like, there's no way I can qualify. Well, they know it too. So we come back to the issue of banks aren't creating a new money into the economy, and that is necessary for inflation. And so you start to look at the relationship between inflation and banks tightening lending standards. It's very obvious why banks will start tightening lending standards. And with some lag, there's no, it's not like other things where you can kind of dial it in every time. It varies depending on where we're at in the economy. What you see is inflation start to come down. Now, there's a third factor here that I didn't even mention, and that's the pandemic stimulus. So we've heard reports from the Fed, and one of the challenges, Anthony, that we've had is there just isn't really a good pulse on, we hear bank CEOs say, no, you just flush the cash. We have other people say, well, I don't have any. So, but what we know based on the last Fed report is somewhere around the end of the third quarter. So you have the third quarter, people run out of money. You have student loan repayments back, and then you have higher payments on the credit cards, which we know are darn near maxed out, if not close. Plus, on top of that, banks aren't originating a lot of new loans. That's going to start to contract along with the new money creation. So that starts to go negative. And you start to answer the question is, why does inflation always come down in these situations? Because people need money to go spend. If there isn't the money to spend, you don't have the demand. The CPI is really a function of supply and demand. Demand is going to come plummeting down. We know that retail inventories are sky high. We know that right now there's ships coming over with holiday stuff. We have the back to school season. We've got holiday coming. What are we hearing from retailers? Gosh, we hope people come and spend. We're nervous and we're hoping because they're going to have way too much inventory on top of the way too much inventory they have. It all tells us if at the least we're going to continue to see disinflation. My base case is we're likely to see outright deflation.
And how would the Fed get control of deflation?
Cut rates. That's they're gonna. One thing I've been saying is they're gonna go from rate hiking to rate slashing faster than anyone can imagine. Because once we see the CPI get near their target. Now I know this week we're gonna get the report, but maybe over the next month or two, at some point it's gonna hit that. They're gonna start to hey, celebrate, get out the pom poms, we did it, see how great we are, and then all of a sudden it's gonna drive straight down below that. And then they're going to say, oh, well, that's probably transitory. And it's going to happen again, and they're going to panic. Lights out panic. You're going to start to see banks start to fail. They're going to slash rates. They'll be at zero faster than most people will ever believe. It'll probably be the fastest move to zero in the history of central banking, and it won't work. It won't fix it. That's the problem that I'm seeing is it's too little too late. And the Fed, if they're going to do something, they have to be ahead of the 8 ball. They're always behind it. They don't get it. They don't understand what the inverted yield curve that they've inverted. They don't get it. They don't understand what it means. They don't understand how to transmit it into tighter lending standards. Although you hear them, they'll say, hey, lending standards have tightened. Great. Do you know why? No, they don't. They actually do not have a clue. So if they were concerned at some point that this whole system was going to just, grind to a halt, they'd actually be cutting rates right now a little bit, trying to at least give the market some confidence, maybe start to move toward getting that yield curve uninverted. The problem is they're not, and we've seen that in the past. The Fed's always the last to react to whatever crisis is going on. In this case, Fed's going to be back to zero faster than we can blink. And even though they say they won't do QE, well, that's the only other policy tool they have. So of course we know they're going to do more QE.
So do you see this being worse than 2008, or do you think it's probably not going to be on the global scale? Or what are your thoughts on that?
Yeah, it'll be worse than 2008. And I don't mean to say that to be doom and gloomy. I mean to say that people don't understand is, when the pandemic hit, the U.S. government borrowed a monster amount of money, trillions and trillions of dollars, and gave it to people. And then we started to spend that. And that really created this massive amount of prosperity. So if you start looking back at history of monetary policy and bubbles, you see kind of this repeating kind of thing. Somehow a lot of money is created, whether it's directly printed, as we've seen in the past, or whether it's borrowed, or there's credit expansion. You see these big bubbles, but they have to pop and come not back just to where they were before the bubble started. They go below that. And that's the challenge we're facing is everybody's got this belief that, hey, the economy's reached a new normal. The problem is that new normal, that money is gone or almost gone. So what happens? If the banks aren't lending, if people aren't spending, then we have to have a mean reversion, and we usually overshoot that reversion to the downside. In that case, to me, the base case is it is going to be worse than global financial crisis because we have this massively inverted yield curve. I mean, it's massive. And if you think about like, okay, so maybe the Fed goes back to zero, the curve starts to normalize. Well, what about, let's just talk about the commercial real estate market here in the US for a moment. We have this whole work from home thing, which for a lot of people has been wonderful. They get to spend more time with their families. They have less stress. It costs them less money. It's great. However, what if you own a commercial building right now? This is the worst thing in the world because instead of having, 80, 90% occupancy rate, which of course you could easily sell and get a loan against and finance, now you're at 50%. In some cases, some buildings are outright empty. So if these loans come due on these properties, they're going to have to go to the banks and say, look, I got a 50% occupancy. I can't pay this loan anymore. And the banks will say, well, it's not our problem. You need to write the loan down. And they're going to say, no, it is your problem because I hold this building in a separately held LLC from all my other buildings. And if you didn't know this, Anthony, this is exactly how the commercial real estate business is done. The banks know it. They still lend against it. So anyone that owns commercial real estate, they're all holding these buildings as separately held LLCs under the parent company. And all they say is, fine, we're just in default. We'll walk away. You can have it. And the banks are going to say, well, we don't want it. We don't know how to manage an empty building. Well, guess what? We don't either. So you can have it. You can go ahead and hurt our credit rating because guess what? It's not going to hurt us at all. It's not going to impact any of our other operations on a big scale. So go ahead. You penalize us. Now all of a sudden you've got a commercial real estate crisis. And then maybe what happens is you see a big push for businesses, maybe even by the government. Maybe there's going to be subsidies or tax credit. Hey, if people go back to work, you get a break, and all of a sudden you're going to see this work from home the thing end. And I know people say, well, I don't want that. I'll quit my job. Fine, quit. Because what's going to happen is without this commercial real estate market, a lot of people don't understand that municipalities, counties, cities, they get a monster amount of money in tax revenue from these buildings. Well, if they're empty or they're in default, they ain't getting paid. So there's a problem. All of a sudden, tax revenue at the local level starts to plummet. They're now forced to lay off. You start to get this just cycle where you can't stop it. And so I think at some point, there's going to be a massive push to get people back to work, get these buildings reoccupied. But the banks, they can't even survive that. Not even in a normal economy right now, because they've got to write down so much of these buildings. I mean, we're seeing transactions 60% off, 70% off, 80% off the last purchase price. Somebody has to eat it. Fortunately, it's going to be the banks. And we already know for a fact, they literally have no money. They have it's not like, hey, we're doing a 2 or 3% haircut and we'll get it back over time. They can't eat it. So yeah, I look at this, Anthony, and I say, once this thing starts to snowball to the downside, going to zero by the Fed isn't going to change it. Quantitative easing is not going to change it. They'll do both of them. But the problem is that is to the extent of their policy tools. Something's going to change in the meantime, but I don't see how they can stop this all from happening.
So it sounds like you think this will be the end of like our current debt cycle that we've had over the past 40 years. Is that what you think it will be?
Oh, I'm pretty sure there'll be more debt issued somehow. I mean, that's the other factor is we have all these really high debt loads. The debt has to ultimately be serviced. So there's a trade-off of economic expansion through credit versus, hey, we're going to have to pay down this debt through higher taxes and savings. And you look at the baby boomers, this is going to be a big hit to them because a lot of them now have retired. The stock market's up. They're buying that it's going to go higher. They're overexposed to equities. You get a massive correction in the market. They're coming back to work, or their spending is going to go to nothing because they have no other choice. They literally have none. And once you lose the boomer spending, well, the rest of us are in trouble because that cohort spends a massive amount of money. We need them. So yeah, there'll be some hope to get the stock market back up to bring their spending power back. But at their age, once they've taken another big hit, they're not going to gamble on this again. They're going to go into conservation mode. They've been there before. A lot of them are Depression era babies. They know what it's like. They're going to come back to this. But if by some stroke of a miracle, this whole thing continues to work, phenomenal, but the history of these inverted yield curves is a problem. This is one of the biggest ones we've seen in ages. We've seen the banks massively tightening lending standards at a rate that's usually seen at the peak in prior crises. We're not even in one yet. So I look at all this and say, when the machine just grinds to a halt, it's way too late for the Fed.
Yeah, it's interesting that you mentioned depression babies. It does sound very depressionary what you're sort of saying, similar to the 1930s, where we see real deflation, massive banks collapsing, um, unemployment. I guess maybe not to the extent that we saw then, but all these things are going to be happening, and it's going to be quite scary.
We'll see massive unemployment. That comes with it. But there has to be a price to pay for borrowing all this money and stuffing into the economy. And you start looking at Keynesian economics, and this is it. This is the whole idea. You borrow a bunch of money, you get through whatever the downturn is, and you reach a new plateau, a new normal. But history doesn't say that that's true. That's just the fantasy of the textbook. So no one believes that we are going to at least minimally revert back to where we were pre-pandemic. The reality is, once we start making that move, we go down even further because there's just so much more debt. And that debt has to be serviced. Of course, the Fed will have to lower rates because people won't be servicing their debt. I mean, we already heard a report from out of the Fed that a couple months ago was the first time that they started noting that households had trouble paying just their basic bill. I mean, the math here just isn't working. Now, the problem is the stock market thinks soft landing and people are very euphoric about it, betting big on it. The reality is the banking system's hemorrhaging. The monetary system's just barely got this thing held together. And as we get out of as the pandemic savings drains out and we head into the holiday season with these high interest rates on the credit cards and student loan repayments and these commercial real estate buildings start to come due, it's just going to be a problem that I don't believe we're seeing enough money being created by the system, which we're not, to keep the game running.
Yeah, so I guess traditionally people would think that if interest rates are cut that quickly, then the dollar would decrease in value. But it sounds like there'll be a shortage of dollars and a shortage of bonds. So would it have the opposite effect, or what would happen there?
Well, there will be a shortage of dollars because people will look to the dollar, for a point of safety, and that's kind of what you see. Normally, fiat currencies. I mean, the Fed has no control of it, even though there's a fantasy that they do. And there's people draw these wonderful charts, and you start looking. It's like, well, there's no correlation here. But what we do know is the value of a currency is based on demand for a currency. So it's not unusual that when the global economy slows, we should see all fiat currencies slow down. Now, why are we not seeing that with the dollar just yet? Well, because the U.S. economy is still, the strongest out of kind of what's going on. Now, when we see ours slow down, the dollar will weaken. But during crises or pandemics, recessions, why do you see the dollar shoot up in value? It's a safety trade. People around the world, including Americans, will want to hold their money in dollars. You'll have this, we already know there's a global dollar shortage, so there'll be a big push into the dollar. That will send the dollar screaming higher. And if you want to do something that absolutely destroys the U.S. manufacturing sector, drive the dollar way up, the business will go all the way overseas overnight. That won't be an issue. It'll be gone. That will just add to the pain in the U.S. of higher unemployment as businesses say, look, we can't compete. So we have to do the one thing we can do, and that's shed workers. We don't want to, but we have to because our rent's not going down. Our insurance costs aren't. All these other costs are up because of inflation. We've got a lot of debt. So the only answer will be to lay people off. But unfortunately, Anthony, it's just what we see during these cycles. Even though we keep hearing, how there's just a massive shortage of labor, that it always eventually changes, and it changes at the worst possible time.
Yeah, and we've talked a lot about the US, but what are you currently seeing in, I guess, other countries? You look at Europe, UK, and China. I guess the big three outside of the US. Are they worse than the US, or what are your thoughts there?
I look at those countries that say they're ahead of the game. I mean, I think our banking system is just being marginally held together. I think if the truth came out, it would be like, if it wasn't for the Fed support at the moment through all these loans, the banking system is literally insolvent. I don't know who goes down first, China or Germany. I mean, Germany is, their manufacturing sector is terrible. We just saw the recent PMIs, and what did we see out of those? New orders were, at first they thought, there's going to be a resurgence of new orders. They said that has dropped way off and headed lower. You're talking about backlog of orders. So this is really important, is when you have workers, well, they do the new stuff. And when there's not a lot of new stuff, you go to your old stuff and so you work through your backlogs. Well, I believe in the last report, they said they've been working on the backlogs for 11 straight months. So there's a point where you've got a bunch of workers, not enough new orders and no old orders. And then you suddenly, somebody at the management level says, well, we got to start cutting. That is coming for Germany. Whether they beat China to the punch of the downturn, I don't know. China's situation, I mean, it seems like every week it's getting a little bit of worse. We haven't seen Beijing, kind of come in and say, we're going to flood the system with a bunch of stimulus, which is what I know the rest of the world is hoping. But again, you start to think about this from the Chinese, consumer's perspective is, they go to work because they're the largest exporter in the world. If they see their factories not humming along, well, they know demand for the rest of the world's going down, and they're not going to spend. And that's what we're seeing is they're just choosing not to spend. We're seeing their real estate market. They know that those property developers may not even finish building something they buy. That's a hit to demand. The banks are tied too deeply to this. So I don't know who goes first. Either Germany pulls down the Eurozone and takes everyone with them, or it's China, or maybe it's simultaneous. But I look around the world and I don't like what I see at all. Because Anthony, you want to see at least one bright spot. You want to say, hey, you know what? In 2015, 2016, the Chinese economy was robust enough and sort of kind of helped grow the rest of the world out of this. You look around today, the problem we have is, you think back to the pandemic. What happened? We reset, everybody came back to the starting line. And some people started out the race a little before everyone else, but virtually at the same time. Now, historically, you look around, study the global economy, and you see at different times, one country will be in a recession and others will be in expansion. And somehow those expanded countries pull out the country in a recession. So we don't often see everybody kind of lined up together. Well, the pandemic reset the race. So the problem we have now is we have nobody that's kind of at the beginning of the race to say, hey, I can help those of you who are at the end. So I think that's a huge challenge. We started this together. The only answer is global synchronized recession, mixing a couple financial crises along the way. And that is, unfortunately, what I see as our outcome.
Yeah, well, if you think about the US has the most growth recently, so it's sort of carrying the the team. So if they go down, it's not good. And I think I was listening to a really interesting podcast that actually talk about how GDP is measured and linking it to new rules that the UN have implemented, where it's measured in a different way. And apparently, the US and the UK are the only two countries to have implemented it. And the US has obviously had this dramatic increase in GDP growth percentage recently, and then the UK has just revised a lot of its numbers. So it seems like maybe these positive changes have been due to this new way of measuring things, and it might be overlooking some of the cracks we've mentioned here.
Which is terrible if it's true. And I'll tell you why, because you have people like the Federal Reserve who make policy based on this data. We keep seeing a non-farm payroll report revised lower. If you're making policy on inaccurate data that's kind of massaged to look better, even though, oh, it's okay, don't worry, 3 months from now, we'll just revise it down, no one will know. But the Fed's making decisions right now based on data that's getting worse. This being revised lower, that's not a good thing, because if the Fed had, or at least we can just pretend if the Fed had the most accurate data, they would still make the wrong decision. That's not the problem, but maybe they wouldn't make it as extreme of a bad decision. We keep hearing today that the Fed may pause at the next meeting, but they still think they might raise rates. The yield curve tells us they've already made the mistake. The mistake's in the books. The only problem is, people say, well, the yield curve hasn't come true this time. Yeah, there's only one reason why, because you look back in history and you see just mild inversions or slight inversions, and next thing you know, you're 6 months away from a recession. Why not this time? Pandemic stimulus money kept it afloat. And then it was the credit cards. Stimulus money's almost gone, if not all the way. Credit cards are tapped out. The music's about to stop.
Yeah, so if we look at, you've mentioned that the boomers are going to really struggle because they're the major asset holders. So what are the assets that you think will maybe perform very poorly during such an event, and what assets do you think will perform well?
Usually you see stocks and real estate perform pretty bad. Beyond that, interest rates will go down. So the bond market, we'll see Treasury securities usually do extremely well. Corporate bonds, I think a lot of corporations are going to be forced to lay off because they've got a lot of debt. I don't know how well, those bonds will actually do. I mean, it just depends on what companies kind of hold out. I'm sure there'll be big companies like Amazon and Microsoft that won't be much of an issue, but we'll start to find out who these zombies are that are marginal, and they're going to be forced to lay people off just to pay their debt. That then we'll come back to the whole let's drop rates, extend the payments, drop rates, extend the payments, and then pray to the monetary gods that it worked. And if it doesn't, then that's the risk we face is we can have a downturn and then the patching doesn't work. And then you have another downturn. We did see that back in the 80s. We had back-to-back recessions. So is that possible? Yeah, it is, because you have this very large baby boom generation, not just in the US, but around the world. They're in retirement. They take a hit to their savings and their stocks and their investments. Their spending stops. They are done. They are too old. They can't play the game. They can't get back in the game. They will just park their money and just slash their spending. And then it's game over, because you look at our global monetary system, it's consumption based. We need people to consume more this year than they did last year and the year before that, and so on and so forth. We need them to borrow more money and spend more money. You take a big chunk of the population out of that picture who says, hey, you know what, I can't play anymore. Well, that means the rest of us got to step up to the plate, and that's just not likely to happen.
So, Steve, thanks so much for your time today. I really appreciate it. What is one message you'd like people to take away from our conversation?
Well, I think the one message is we'll just say, don't believe what the central bankers say. They've never been right, and I don't think they're going to be right this time.
Short and sweet. Unfortunately, it's not very nice, but yeah, it seems like that's always the case. So, Steve, thanks so much for coming on. If anyone wanted to find out more about your work, we mentioned you have a great YouTube. Would that be the best place to find it?
Yeah, Anthony, they can find me on YouTube, Twitter, Facebook. Just put my name in search engine for any of those platforms, and you'll definitely find me. So always a pleasure to be on your show, and I look forward to the next time.
Yeah, thank you so much. And yeah, hopefully we'll be able to do it sooner. And we'll see. It seems like, yeah, we could have experienced what we've mentioned before then. But yeah, thanks again.